welcome to Business Time. I am Melisha. Now, if you have not yet subscribed to my channel, I need you to subscribe. Also, remember to like and share. Now, today we will be looking at the accounting cycle. Now, you may be wondering, what is the accounting cycle? The accounting cycle is a process of recording and processing all financial transactions of a business. Now, when we talk about transactions, if the business buys raw materials, that's a transaction. If the business sells goods or services, that's a transaction. So all business transactions need to be recorded. So the process begins from when the transactions took place until its inclusion in the financial statements. So there are steps that must be taken, right? That is a part of the cycle. Now, the cycle is usually for a 12-month period, and the process must be repeated whenever the current cycle is up. What do I mean by that? So let's say the business opened in February 2022. Usually businesses will start doing the accounting process when the business opens. So it has to be 12 months. So the cycle for this business will be from February 2022 to January 2023. When January 2023 come and is gone, then the next accounting cycle will begin the February of that same year, 2023. Now, you must be able to look at a diagram and be able to see the steps that must be followed within the accounting cycle. So let's look at one. The first thing that must be done is that the business must identify and analyze the transactions from its source documents. Now, what are source documents? These are documents that transactions were recorded on at the time of the transaction. For example, sales invoice, purchases invoice, petty cash vouchers, cash receipts. So of course, if your customers come and buy something from you, you give them a receipt, don't it? Exactly. So those are referred to as source documents. So the business must carefully store all of its source documents. The second thing that must be done in the accounting cycle is that transactions must be recorded in the journals, or what we call books of original entry. Now, what is this all about? Every transaction must be classified, and then each transaction must be entered into these journals, or what we call books of original entry. So what are some books of original entry or journals? You have the purchases day books, or sometimes called the purchases journal. You have the sales day books, also called the sales journals. You have the returns inwards journals. You have the returns outwards journals or day books. And you have the journal. So take note that after you've gathered all your source documents, then you need to enter each transaction in the journals, the different journals or books of original entry. Now, after all of that is done, the third step is that you will need to post journal information to ledgers now used in the double entry system, and you will learn about the double entry system a little later on. So some examples of ledgers that you're going to learn about later on are like the general ledger, sales ledger, purchases ledgers, and you have like cash books and petty cash books that you're going to need to also post these information into. Now, when all of that is done, then you have what is called the trial balance. After you've entered everything in all the ledgers, then you have to do the trial balance. Now, what this trial balance does is that it helps you to check the arithmetical accuracy of the double entry records that were made in the ledgers. Now, in other words, what you're required to do is to make sure the transactions are entered correctly. Don't want to make any mistake. You don't want to reach financial statements and then you realize, oh my word, we have made mistakes. So it's important that the trial balance be done at this point to make sure that there are no errors. Now, the fifth step and final step in the accounting cycle is to prepare your financial statements. After the trial balance is done, right? And other information and adjustments are done, if there are errors or anything, you make those corrections, then the financial statements are prepared. Now, financial statements include your income statement, also called the trading and profit and loss account, and the statement of financial position, also called the balance sheet. Just a quick insight, the income statement calculates the profit or the loss for the accounting period, because of course the business wants to know if it has made a profit or a loss for that year. The statement of financial position now will show the liabilities, what the things that the business owes, the assets, the things that the business owns, the capital at the end of the accounting period. So remember now, there are steps that must be followed in the accounting cycle for that financial year. Have your source documents, record transactions into your journals, post to your ledgers using the double entry system, prepare your trial balance, then you make a count of any adjustments or information that needs to be added, and then you do your financial statements. This is the simplest way of showing the accounting cycle. All right, hope you learned something. See you next time.